And just like that, markets around the world are looking rather shaky. Semiconductors led the selling and 2023's winners are now looking like a fish out of water. But where we are doesn't determine where we go, and the only thing that matters this week is path and PCE. We get inflation data ahead of a very big week of earnings, with over $15 trillion in market cap reporting this week. To say we're in for a big week is an understatement. So in times like these, it's best to get back to the fundamentals. So today, we're going to be looking at earnings, sentiment, as well as seasonality to get a macro view of everything. We're also going to be looking at individual stocks I'm eyeing during this pullback. Market corrections are simply opportunity. I'll show you what I'm looking at and where I think the market will go. Is this the end of the bull run? We've got a lot to talk about, so let's roll the tape. Welcome everybody to the daily recap show where we talk about stocks and the financial markets. My name is Chase. If you like this video, please subscribe, hit that notification bell. We're trying to get 10k subscribers by the end of May. Like this video and leave a comment for the algorithm. Let's get into it. Now this is the weekly heat map of the S&P 500 and we can see some very clear trends this week. The first is actually financials, guys. I said this last week when financials got absolutely hammered on earnings and everybody said that earnings were bad. It's not the case, and we're starting to see a lot of that upbeat action coming to the tape right here. Financial earnings looking very, very good, and we'll see what Visa and MasterCard can do this week in their earnings. Technology took the most of it, and that's why the major indices, the market cap weighted indices, were down heavy this week. But there were some other clear trends we saw. We did see quite a bit of a defensive rotation here in consumer defensives, telecom services, as well as utilities. And then we also saw, because of the geopolitical tensions, aerospace and defense stocks gain on the week. And then we saw healthcare plans do really, really well on the back of United Health's earnings. But other than that, we saw highly cyclical, rate sensitive sectors not do that great. I'm looking at tech, consumer cyclical, stuff like real estate, industrials, right, and energy, because oil pulled back in a very big way at the start of the week from the $88 level all the way to about $80. We saw energy stocks take the brunt of it. But all in all, it was a very mixed day. If you were in the right sectors, if you were in the right stocks, you probably did really, really well. But if you were heavily weighted to stuff like technology, discretionary, com services, yeah, it was a rough week for your portfolio. But looking at the major indices, have a look at the Dow Jones, actually up 0.01%. Very, very interesting. And this is what happens when you have quite a diversified portfolio that's not weighted by market cap. You can get outperformance, especially when you have a huge amount of stocks in stuff like aerospace, defense, financials. You have a bit of a mix in utilities, healthcare. When you have a mix of various sectors and just the right stocks in the right sectors, you can actually completely outperform the market. Look at the S&P 500 down 3%, very similar to the IWM. The equal weight RSP actually did really, really good. In fact, they were actually up on the week from Wednesday to the close. Very, very interesting when you actually consider that. And then the Nasdaq due to technology just took it on the chin, down 5.36 for the week. But you have to understand that, you look at the charts for the last year, the Nasdaq 100 has outperformed every single index by a wide margin. Now, looking at US sectors for the past week, we can see the best performing sectors was utilities and then KRE. And I've been saying this for the last couple of weeks. Regional banks is up 1.72% right here, but that is actually a risk off move. You see a ton of money managers, fund managers, hedge funds are actually short regional banks. So the risk on move for regionals is to short them. So when you're risk off for the week, what do? You buy back regional banks. And that's why we're seeing that upbeat action in regionals. Other than that, we saw defensives take the cake, as well as safe havens this week, GDX, XLP, XLU, so staples, utility, gold miners. And then because of earnings, we had financials as well as healthcare do really, really well. Other than that, bit of a bloodbath here in all of the indexes, with the S&P 500 down 3%. And then we had stuff like real estate, discretionary, home builders, rate sensitive, and the mega caps, technology, software, semiconductors underperformed the SPY. So definitely some trends here, with safe havens, defensives at the top, and then sectors with great earnings in second place, and then everything else just took an absolute dump on downside flows this week. A bit of a risk off week. Guys, today we're going to break down the IWM. Yesterday we looked at the S&P 500. So go ahead, check out yesterday's video if you want the full analysis from the weekly down to the daily, everything in between, what I think is going to happen here with the S&P 500. But today, the IWM, small caps, the Russell. And now firstly, this is the weekly chart. Zooming this out, we are in the context of a secular uptrend, a secular bull market here in the IWM, but in the context of, I guess you could say, a cyclical downtrend, at least from the highs to where we are right now at this point right here. Now we are at a very, very critical zone in the IWM. If we just go ahead, put a simple trend line at the week's close right there, you can see that we're at a critical zone where we used as resistance once, used as support here, here, and here, and now we are approaching this line and we are at an absolute critical level. The IWM needs to find support here, otherwise we can definitely see lower levels ensue in the IWM very, very quickly. Now let's just zoom in a bit, right? This is the weekly candle, so you can see that there is quite a bit of a wick at the bottom here. So we did see quite a lot of bears come into the tape on Friday. They saw this area as value, and I don't blame them. This is the exact place where we really started the second leg of this massive uptrend that we've been in here in the IWM. And we actually did go ahead and make a new 52-week high at this point. So that would mean a low, higher low, right? New 52-week high. At the same time putting in a high and then a low, higher high, 52-week high. That is bullish, and we are still in the context of this massive bullish uptrend as long as we can hold right here and then go make another higher high. That would just mean we put in another lower high and then a new 52-week high, potentially taking us to those all-time highs. However, it gets mission critical here for the IWM because we do not have a lot of room to work with. I mean, at 188, things get really serious. So the bulls need to step up this week very, very quickly, and there needs to be no close below this level right here. We cannot afford a close below 187. Let's actually just call it 188 flat. There will be no closes below 188 flat. Otherwise, we do drift back into this massive range that we've been in for the better part of 12 to 18 months. And it's the massive balance zone. I guess you could call it a correction in time. The second we drift below the 188 area, all of the work the bulls put in since October was virtually for nothing because it opens up lower levels upon a technical breakdown of this uptrend. However, we do have to look at everything in context, and we are still in this uptrend. Things haven't broken down just yet. We still need to clear some of these lower levels. Now, looking at the daily chart, not much has really changed from the daily to the weekly. It's all pretty nuanced on both charts. You can see that we are in the context of this uptrend right here after making these highs, and we are still in a downtrend. I don't think there's much that you could take from the daily chart into the weekly chart. They're very much the same. However, what does change is a couple of the technical indicators. The very first thing I want to show you guys is that we are approaching the 200 moving average right here. And I would say that where this 200 moving average aligns and where price action is right now is absolutely perfect for a bounce higher. And this green candle kind of signals it. You can see a couple of the algos traders, 0DTE traders, were front running probably a bounce here in the 200 moving average. At the same time, the RSI is pretty much at oversold conditions, not quite below this green line, but normally when we do get to areas right here, we tend to bounce very, very heavily. At the same time, look at what would have happened if you bought the IWM right here when the RSI was overbought. Sure, you would have sat through quite a bit of a drawdown. However, the risk to reward would have been skewed to the upside had you just waited. And this is sort of where we are right now, at the bottom, closer to this overbought area right here. Another technical indicator I want to point to is the advanced decline line, the ADL line of the Russell. Very similar to the S&P 500, you could see that as the Russell has moved down in price, the ADL line has actually moved sideways, which means more issues in the IWM are increasing or moving sideways relative to the price. That probably means some of the bigger names at the top of the index are influencing price more than others. Maybe we're looking at stuff like SMCI. So there's a bit of a positive breadth divergence right there. All in all, next week, the bulls need to act very, very quickly, especially early into the week leading up to that PCE print. They need to find support here right at the 200-day, move above the 193 area, use as support, and then continue the leg higher towards the 200 area. That's the safest thing to do. If we do go ahead and actually break this 200 moving average, it's going to be very, very grim for the bulls. And I do think the bears at that point will probably take over, and we could see levels as low as 179, 170, 162. So very, very critical for the bulls to step in at this point right now. And if you want small caps, if you want small cap exposure in your portfolio, this is the place to buy and look for further upside, because I do think we probably go higher this year, but manage risk accordingly. Now, fear is driving the market. That's something we can't deny. In fact, guys, we were just at the neutral zone a week ago, and not even a month ago, 2 weeks ago, we were here in the greed zone. We've now moved to the fear zone. and we're closer to the extreme fear than we are to neutral, and that's how quickly markets can flip. This to me is opportunity. The S&P 500 is down 5% from its highs, a little bit more than 5%, and I would say you should start buying at these increments. Generally speaking, I do add every 5% down, and then every 10% I add in a very big way. So we go down 5%, I'll add a little bit. Go down another 5%, I'll add a lot. Go down another 5%, I'll add a little bit. Go down another 5%, I'll add a lot. And generally speaking, the average S&P 500 correction is 23%. And in those 4 intervals of 5, 10, 15, 20, those are really, really good positions to add. Just a bit of knowledge there for you guys. That being said, fear is driving the market. And if we do see more downside next week, it would be completely normal and the sentiment of the market. However, if we do look at longer term indicators, Wall Street is still not euphoric yet. So you can see here that both the sell side indicator is still here in the middle. And this just tells me that what we're seeing is probably just a garden variety pullback. Wall Street is not euphoric, retail kind of is. And so I think we're going to see this pullback in the region of 5 to 10%. Maybe 6, maybe 7, maybe 8, but I don't think we're going to go anything more than 10%. If we see a pullback greater than 10%, that probably means there is some form of underlying weakness in the economy, maybe a growth scare, and I just don't see that in the data. That could change, but when it comes to economic data, it really takes months and months to get going. You have to see a firm trend, whereas stock market technicals can turn at any point. And as it is right now, I just see this as a garden variety pullback, and the data points to that. Now, looking at data points, this right here is S&P 500 performance after we break a 5-month winning streak. So leading up into this April period, we've had 5 consecutive months from November to March of just upward gains. April right now, we're actually down 5.46% for the month. And this is essentially the returns that we can expect in the next month, quarter, 6 months, and year after we have a 5-month winning streak and then we break it. Have a look right here. 1 month forward returns, 22 up years, 8 down years, 1.88% return. The next quarter, 25 up, 5 down. Look at that risk to reward, kind of crazy. 3.86% return. 6 months later, 27 up, 3 down, average return 8.95%. And then 1 year later, 24 up years, 6 down years, 10.24%. So this opportunity we're seeing, you want to buy the dip. Okay, guys, and this is a statistically significant data set. We have 30 data points right here, about to hit our 31st data point. And momentum brings momentum. We are in a bull market. Don't lose sight of the fact that equities are poised to go higher. And this is just a simple pullback. 5 to 10%. It's a garden variety pullback. It happens, and it's actually really healthy for the market to consolidate, pull back, have a bit of a correction in time, in price, and then go from there and then make higher highs. Let's talk earnings. Big week of earnings next week. Not so much on Monday. We have a couple of big names. We got SAP, we got Cadence Design Systems, we got Globe Life here. They have quite a lot of controversy happening. Then Tuesday, it really gets started before the open. We have stuff like Spotify, Lockheed Martin, RTX, Pepsi. Then after the close, we have Tesla, Visa. Those are the 2 big ones. We also have Texas Instruments, Chubb Insurance. So a big week here on Tuesday. Then on Wednesday, we have Boeing before the open, Meta, Chipotle, ServiceNow, Lam Research, Align, very big names, IBM as well. Thursday, we have Microsoft, Alphabet, Intel after the open, as well as Western Digital. And then Friday, we have a couple of these energy names, Exxon, Chevron, AbbVie, Colgate Palmolive, and a couple of others. I've actually been looking at ACMR Research. It's a semiconductor company. So a very big week of earnings, huge week, huge amount of market cap. The market's really going to move, a lot of volatility, particularly here on Tuesday, Wednesday, and Thursday. So how are we tracking ahead of earnings? So this is S&P 500 revenues, and you can see right here, this is the overall market. 42% of companies are reporting below revenue estimates. 58% are reporting above revenue estimates. And the general long-term average is about 68%. So we're reporting actually well below the historical average and the consensus estimates. However, it does improve here in the earnings. You can see that below estimates is actually 15%, and then in line or above is actually at 85%. So revenue not quite as good, earnings coming in really good. And we saw that with stocks like Procter & Gamble. They missed on the revenue front, but they beat on earnings. So 85% of companies reporting in line or above earnings here in the S&P 500, and that's well above the long-term average of about 70% as well for both those figures. Now looking at blended earnings, we could see that we are right now reporting 2.9% growth. However, if we exclude energy, we're looking at 3.3% on the earnings side. But something to note that if we exclude Bristol Myers Squibb one-time charge of $12 billion related to its acquisition of Karuna Therapeutics, When you exclude this one-time item, you actually get an EPS growth rate right now of 6%. So this is having a major effect on the current blended earnings growth for the S&P 500. And I do think you actually have to exclude this because eventually these earnings will be reflected in BMY as well as on their balance sheet. It's just that the acquisition has taken place at the wrong time. And so they have to report earnings as the current asset stands. And I do think in the next earnings cycle, you'll see a huge uptick in BMY's earnings reflected in the S&P 500. So earnings coming in actually pretty good, I think. But on the revenue front, we're actually looking at 3.3% growth and then excluding energy 4.1%. The best sectors for revenue growth right now, we're still looking at stuff like technology, comm services, and healthcare. And then on the earnings front, it's very much the same sectors, comm services, technology, utilities up 17.9%, discretionary 2%, and then financials. The only red sectors here, you're looking at energy, materials, and then healthcare on the earnings side. Now, where does that leave us with valuation? Now, this is aggregate valuations. And guys, just a couple of weeks ago, the S&P 500 next 12-month PE was sitting at 21.2x. We're now sitting at 20 times. It's crazy what just a 5% pullback can do. We're looking at a PEG ratio, which was at 1.5 times. We're now sitting at 1.3. EV to sales at 3 times, with a free cash flow yield of 3.5%. So not bad, but not entirely great. And then moving down, we see the most undervalued sectors on a PE basis being energy, financials, and real estate. And this right here is kind of crazy when you think about it, real estate. Now, the most undervalued sectors on a PE basis is energy, financials, real estate. The most expensive is info technology, consumer discretionary, industrials. And I wonder how much of this actually has to do with stuff like Tesla and Amazon. So I was looking at some of the names in here, stuff like Lululemon. Yeah, they've had a massive pullback, but they're trading at very reasonable valuations. But then other expensive sectors, we got industrials, we got materials, and then sort of like middle of the road sectors in line with the S&P 500 or below the S&P 500 is stuff like staples, comm services, healthcare. And I really do like comm services, healthcare. It's a great place. I say this almost every single week, but look at their PEG 1.1. That's really good. Look at the free cash flow yield of comm services 3.9%. That's actually above the 10-year, not so much for the healthcare sector. And then trading at, EV to sales 4 times, EV to sales 1.9 times. Very healthy valuation metrics. If you are looking for growth at a reasonable price, look at these sectors. If you're looking for absolute growth, look at information technology or discretionary. And if you're looking for value, look at energy, look at financials, look at real estate. Now, looking at data in the week again, guys, the focus will be on Q1 GDP as well as personal income outlays. So here on the 26th, we have PCE month over month, year over year, headline and core. So let's actually have a look at the consensus estimates right here. So PCE headline month over month, we're expecting a 0.3 figure and a year over year figure of 2.6. On the core side, we're also expecting 0.3% and then 2.7% year over year. Now for GDP, we are expecting a 2.3% quarter over quarter, seasonally adjusted, and then a GDP price index of 3%. GDP will be released on the 25th. We also have durable goods orders here on the 24th. They do affect discretionary stocks as a whole. And then we do have PMIs on the 23rd. So a very, very big week of data, very, very big week of earnings, a very volatile week ahead, guys. So make sure you are prepared for volatility and have some cash ready on the sidelines, looking to buy the dip if we do go lower in this market, because risk is to the downside right now. And especially if some of these data prints, particularly PCE, particularly GDP, come in, they miss, not going to be good for the markets as a whole. Now let's actually talk about some stocks I want to buy during this dip. Now the first stock I want to buy in a dip is PayPal. Now last week, if you go and click this link right here, I actually did a full in-depth breakdown of PayPal. So I'm not going to go into it, but it's up 1.38% for the year when the S&P 500 is up 4%. And this company, I think, is being mispriced. And I do think we're going to see a big re-rating. If management can execute this year, I think we're really going to see the street take a liking back to the stock. And we'll see figures far higher than this if everything goes according to plan. Now, the second company I want to buy in a dip is Uber. Guys, this was a company I was very, very close to buying here in December around at the $50 mark. In fact, if you were a subscriber in December at the time, I spent like a week going over this company, the fundamentals. I was so close to buying it, never did, and it just got away from me. But I do think that I'm gonna potentially start a huge position in this stock because the fundamentals are absolutely fantastic. Look at this revenue growth. It remained pretty much stagnant, but we've seen a drastic acceleration here after 2021. And you can actually see that throughout the entire cost of living crisis here in 2022, quarter over quarter revenues actually increased. Yes, revenue growth has decelerated. That always happens when you get to the scale of making $37 billion in a single year. However, I do think Uber is severely undervalued and it's finally a profitable business. Uber here for the first year ever actually posted positive free cash flows of $3.36 billion. And I do think that they're going to become drastically more free cash flow positive in the years ahead. And that's just going to benefit shareholders. Uber did actually post a positive year in 2022. But if you adjust for stock-based compensation, it was actually a negative year. And this is incredibly constructive for Uber. At the same time, we looked at this previously. Revenue is actually increasing every single year. But then if you go down to operating expenses, yes, they are increasing, but relatively flat relative to the year prior. But if you actually have a look at it on a quarterly basis, operating expenses are actually decreasing in the last 4 quarters. And that is just Uber finding operating leverage. You could see here the same is true for selling and general admin, which is essentially just marketing expense. So they're growing revenues by spending less on sales, administration, as well as marketing. And that's what you really, really want to see. And the company now has leverage to increase its marketing spend, its general expense, and its administration expense if it needs to grow the company even further. And that's what I love to see. And one thing that Uber has got going for itself is actually its shares outstanding. You can actually see that every single year, shares outstanding has actually increased to just over $2 billion. And I do think that as Uber becomes drastically more free cash flow positive, they're going to start buying back a lot of their shares. And that's just value to shareholders, maybe even issuing a dividend, because I do believe they're going to post $6 billion plus worth of cash flow in 2024. Now, another thing that I absolutely love about Uber is the actual platform. Uber have over 150 million users on its platform every single month. They started out just as a ride-sharing app. They have the dominant market share in almost every single country in the world. And now they also do delivery. And the beautiful thing is they can repurpose this app to do so much more. And they've started getting into that with stuff such as freight, groceries. And that's just a beautiful thing with a huge installed base. Uber also released a social media type platform so that restaurants as well as users of their platform can post about where they're going, and restaurants can use that to advertise. So they're getting into the social media business. That means they can start servicing ads. They can also start servicing ads on their ride sharing platform, their delivery platform. There's plenty of ways that Uber can monetize its huge install base. And I do think that this is such a fantastic company. And for the very long term, I think you'll do very, very well in the stock. But what is it valued at right now? Now we're going to do a very basic discounted cash flow analysis to find our fair value of Uber. Now we've made some basic assumptions. Now the growth rate is the one assumption that's always in contention. Now I've used 30% for a couple of reasons. Now Uber currently has a free cash flow margin of 9% right here. Now management have made it very, very clear that they do plan on expanding that margin to 30%. Analysts are also forecasting Uber's 5-year revenue growth at 13.29%. And on Yahoo Finance, they actually have the next 5-year EPS growth rate at 44%. So I don't think it's absolutely crazy to use a growth rate here of 30%, especially when the company is finding operating leverage, growing revenues at 13% and EPS at 44%. Now I've also gone ahead and used a 9% discount rate, a 2% perpetual rate. I've used their cash and total debt as per the balance sheet, $2 billion shares outstanding. I haven't accounted for any share buybacks, and we get a fair value price of Uber at $93.98. This is the free cash flow figure I've used, and this puts the current price at 26% under fair value at the current price of $69.2. So this does mark a pretty good area to go ahead and buy. You'll be getting the stock 20% under its fair value according to this discounted cash flow for a company that's a market leader and has extremely high barriers to entry. And the third stock I'm going to be buying in a dip is Hims and Her Health. Now I absolutely love this platform. I'm going to do a full breakdown like I did Uber today in next week's video. So go ahead, subscribe so you don't miss my full in-depth analysis of Hims and Her Health. And this right here could potentially be a 20x stock. But if you've made it up until here, thank you so much for watching. If you like this video, please subscribe, hit that notification bell, like this video, and leave a comment for the algorithm. Cheers.